Take us through whether or not this basically 20% move lower in FedEx is something where it's a re-rating of the overall macro picture because of what FedEx sees in terms of weakness globally.
Well, good morning, Dom. Let me be very clear here. The earnings expectations for FedEx in the last 24 hours has effectively gone down by 40%. So even with a 20% move down in the stock relative to its earnings power is actually more expensive today than when it was prior to the close yesterday. Most importantly, we do not believe this is entirely macro focused. We think a lot of this has to do with FedEx specific issues. Let me just give you two numbers. Revenue was up in the company's express business, which is the key problem for this quarter and the next quarter's outlook. Revenues were up in that business, but profits were down almost $500 million. This is indicative to me of a situation where maybe some of the macro changed, but the company did not do a good job of adjusting its cost structure in a more real-time fashion. And the last thing I'll say is I met with the CEO and CFO of UPS 10 days ago. They reiterated every aspect of their guidance. Obviously, we're at Deutsche Bank. We have a lot of contacts in Europe in the parcel industry. We don't believe that what others are seeing is indicative of what FedEx announced yesterday.
So this is interesting. What you're claiming is that these are company-specific, maybe more idiosyncratic issues that are specific just to FedEx because you're not, at least in your opinion, in your mind, having spoken with a big competitor like UPS, seeing the same kind of massive macroeconomic downturn signs that Raj Subramanian at FedEx is seeing.
No, well, it's true that FedEx has a huge presence in trans-Pacific lift capacity, and it's also true that we think FedEx leaned into the pricing opportunity that was created as a result of exiting of belly space capacity during the pandemic. So some of that's payback there. But let's be clear, in Europe, there's two other players that have a much stronger market position than FedEx does vis-a-vis FedEx's acquisition of TNT Express. I think in moments like these, stronger players get stronger and weaker players get weaker. And that's what we're seeing play out. I think this is more a company-specific issue for FedEx than any macro. Listen, we're very close to every freight flow data point here at Deutsche Bank, rails, trucking, brokers, marine. Demand is slowing for sure, but we're not seeing the collapse in pricing power because let's be clear, 70% of capacity in North America is trucking. New trucks were not really produced. We haven't had the capacity creep on new trucks over the last 2 years that we have had in prior up cycles. So the moderation demand, which we're seeing, we're not going to have a peak season, but the moderation in demand that we're seeing is not relating to a collapse in pricing.
Amit, before we let you go, given what you've seen in FedEx and the conversation you had with UPS, just in a few moments here, just give us what your top pick in transportation and logistics is.
Well, I mean, so right now, we've written a few notes more recently talking about chess versus checkers, where UPS is playing chess and FedEx is playing checkers. The good news on FedEx is that it's so bad that it could actually be good in terms of making it clear to everybody that there is a dramatic overhaul needed at FedEx. And UPS provided that roadmap. UPS's equity value has more than doubled since the pandemic under the new CEO, Carol Tomé. And I think that that's a really great roadmap for the new CEO of FedEx, a relatively new CEO of FedEx, to follow this better, not bigger strategy, and also dealing a little bit more collaboratively with their contractor and ISP network, which has been a big source, I think, of market share losses very recently.